Greetings, everyone, and thank you for joining us today to our broadcast 2018 Outlook Through the Looking Glass. A chance for us to look forward, I'm going to say look back a little bit at the year that's just ended and talk about what it meant, what it might mean for the future, and where we're heading in 2018. So obviously we have a bit of a theme here through the Looking Glass, Alice in Wonderland, and I couldn't help including this quote from the Red Queen. Why sometimes I've believed as many as six impossible things before breakfast. And what one of the things that makes me think about this um, is that we have one moment. Sorry, one of the things that made me think about this is the fact that we have just a great variety of news coming down the pike. On the one hand, we hear that tax cuts, for example, are going to create a disaster. On the other hand, we hear they're going to create a panacea. We hear that the world economy is about to collapse. We hear that it's moving into a new period of growth. We hear that the markets have hit the end of the line, and we hear that there's a lot more upside. Um, it's kind of like the opening lines um, of Dickens' Tale of Two Cities. It was the best of times, it was the worst of times. So let's talk now about what I'm planning to cover. An overview of the U.S. and international economies, where we've been last year, where it looks like we're heading this year. Also, a look at the international stock markets, which, of course, are just a reflection of the real economy. We'll talk about the new tax law. We'll talk about its various implications for both individuals and for the economy and the markets. And we'll finally close by talking about how to manage change and uncertainty in a world in which prediction is difficult. Along the way, feel free to offer up your questions, and some of them I'll answer as we go, and some of them I'll wait till the end. And there will be a portion, there will be time set aside at the end of this webinar for very specifically for whatever questions you may have that haven't previously been answered. So some of the major themes that we're going to be looking at are related to this new phase we've moved into in which the world seems to be involved in synchronized global economic growth, which is something we haven't seen for half a decade at this point. Along with that, we've seen a synchronized advance in stock markets worldwide with shifting leadership that we'll talk about in a little more detail. We want to address the question of how much room is there to grow, both economically and in terms of market valuations. We'll also look at the impact of employment rates and specifically low unemployment rates, both in the US and in many other markets around the world. The impact on rising inflation and rising interest rates. Are they rising? Will they rise fast enough to derail current growth trends? We'll talk more about that. We'll talk about the role that central banks, not just the Federal Reserve in the US, but central banks around the country will play in that. And again, we'll talk about the new tax law's impact on the economy, the markets, and your individual finances, including some strategies that you might think about for maximizing, let me put that another way, minimizing your taxes under the new tax regime. So let's begin with developments in the U.S. First of all, we've had higher than economic growth in recent quarters. In the second quarter of last year, gross domestic product rose by over 3%, and that rose to 3.2% in the third quarter and continued above 3%, or we believe it will have continued above 3% in the fourth quarter. This is a level of growth that we've been waiting for ever since the Great Recession, when the U.S. in 2009 resumed. Came out of the recession and got back on a growth path. Growth has been hovering at plus or minus 2% for almost that entire intervening time. So it's a recent development showing that we're starting to really get some traction. Now, this is not entirely unexpected. you've probably heard a lot of stories over the course, of the last 8 or 9 years as we came out of the Great Recession about how the economy had not snapped back as quickly as one would normally expect. The reason for that was often misrepresented. Um, Recessions can be caused by many different things. It's not unusual historically for a recession to be caused by the Federal Reserve beginning to worry about incipient inflation, raising interest rates, and thus choking down the economy. In that kind of a recession, once the Federal Reserve opens up again and eases up, the economy typically bounces back very quickly, and that's what a lot of people look to when they look to the history books. But when you have a recession that was caused by a financial crisis, and the Great Recession was absolutely caused by a financial crisis, then the expectation is it's going to take a lot longer to crawl out of that hole. And the reason is it wasn't caused by a policy decision of the Federal Reserve. The Federal Reserve can put on the brakes by raising interest rates and shrinking the money supply. The Federal Reserve can take its foot off the brakes and have almost immediate sort of loosening effect that the economy can feel if that was the only thing that was slowing it down. But when you have a credit crisis such as we did in the Great Recession, all of a sudden what you have is a situation where individuals and companies have to rebuild their balance sheets, have to work down debt, and to improve their financial condition before you'll have rising demand again. And so what that causes is a much longer trajectory, a much slower recovery. And that's exactly what we've seen, a long, slow recovery that is finally now and perhaps not surprisingly, finally starting to catch trying to, again, get some traction. When you look at individuals and companies, their balance sheets are vastly healthier than they were back in 2008, 2009, and that rebuilding process took place over the intervening years. So now we're in a situation where consumer demand has been rising, corporate profits have been rising, companies have been very good about controlling costs and dropping more money to the bottom line. And we're just coming into a new earnings season, and we'll see if that trend continues. I think there's every reason to believe that it will. Now, inflation is beginning to pick up steam. You may recall, well, let me just say, the core inflation rose 0.3% in December. Core inflation is the measure exclusive of food and energy costs that the Federal Reserve tends to focus on because it's much less volatile. It shows it gives a deeper view of the deep underlying trends. And the Federal Reserve has been wanting to get this measure to 2% for a long time, and has struggled to do so. Back closer to the Great Recession, there was even fear of deflation, a period when prices are falling rather than rising. Well, early last year, when the inflation rate started to dip again, it would approach 2% and then dip and then fall back. Janet Yellen, who was then chair of the Federal Reserve, predicted that it was a temporary phenomenon, that the Fed didn't have to change any of their plans as a consequence of that, and she was proven correct. By the end of the year, the core inflation rate was moving up quite briskly, and it raises some questions about Fed policy. First of all, longer-term interest rates have begun to tick up. The two-year Treasury rate's the highest it's been in 10 years. And this may very well give the Federal Reserve permission, if you will, to get even more aggressive with raising the federal funds rate. They previously indicated that their goal was to raise it 3 times this year, and they've typically been raising it by a quarter of a point. But they may move that up to 4 times, considering the path that we've seen in both interest rates and inflation. So it could go from a current high range of 1.5% to as high as 2.5, which would be a significant move back towards what I'm going to call more normal levels if you look at long time spans and what the Fed funds rate has been. We have these tax cuts that we're going to be talking more about, and they may indeed boost the economy somewhat. One of the question marks left to be answered that we'll have to keep an eye on is whether or not the fact that the economy seems to be operating near capacity. We have very low rates of unemployment, and we do have rising inflation and interest rates. And if the Fed decides it has to raise rates even more in response to rising inflation, this could offset the stimulative impact of lower rates. So we'll see if the lower tax rates have a big impact or a small impact or no impact at all, because as is always true when you're dealing with economic variables, um, lower tax rates will normally stimulate the economy and increase the rate of economic growth. But as the economists would say, ceteris paribus, all other things being equal. And so if interest rates, inflation rates, and unemployment rates remained unchanged, then the lower tax rates would almost invariably raise economic growth. But we don't know what's going to happen to those other variables. And so if we have rising rates and rising inflation, it could very well offset the pardon me, stimulative impact. So now let's talk about what's going on outside the U.S. So excuse me. So the World Bank is currently forecasting global economic growth. So that's all of the world, including the U.S., to be. Uh, excuse me. This is the developed. Pardon me. This is all economies outside the U.S. They're predicting 3.1%, and if you look just at the emerging market and developing economies, they're predicting 4.5% growth in 2018. Um, as you can see by these two lines, the yellow line representing the emerging markets and the red line the advanced economies, growth rates consistently have been higher for those emerging markets, and that's expected to continue. They've become a huge driver. I didn't include a slide for this, but when you look at total economic output, the United States represents just about a quarter of the economic output of the world. Even though the value of our stock market represents about half the value of the global stock market, our economy is actually only represents about a quarter of total global output, with China representing about 15%, and then so on down. But those economies in the emerging and developing economy, pardon me, those emerging market and developing economies uh, are expected to continue growing at least 1.5 times the developed rate. We also, you can see here, this is another measure of the health of the world economy, and that's the rate at which trade is taking place. You can see that global trade was hitting a very low point as recently as 2015, 2016. But since late 2016 and all through last year, the rate of global trade has skyrocketed, which is this very clear secondary marker of the general health of the global economy, and also a predictor of future trends in economic growth. Now let's talk for a moment about global stock markets. And you see we have Humpty Dumpty here. I know that a lot of people I talk to and a lot of what I read in the press suggest that Humpty Dumpty might be prepared to take a fall off that high wall because of what's been going on in the markets, most especially in the U.S. market. Um, but we're not so sure that's something that we need to worry about right now. So last year, markets rose pretty much everywhere. Um, what was different was that markets outside the U.S. in general rose at a faster rate than in the U.S., which has been a reversal of trends of recent years. Now, within the past few years, one of the reasons for those trends has been that the U.S. economy was more advanced in its recovery, its long, slow recovery coming out of the Great Recession, than other economies. Central bank officials and well, I'll just say government officials in major regions and major economies like Japan and the Eurozone made a decision with 2020 hindsight, we can say prematurely to tighten monetary conditions after the Great Recession because they feared a resurgence of inflation, which turned out not to be the risk. And in fact, they sent themselves back into a double dip recession. Whereas in the US, the Federal Reserve at that time under Ben Bernanke was operating in a much more open fashion. He was operating on the theory that there was a lot more openness needed, that the economy was much more deeply wounded than was assumed overseas. And it turns out that Ben Bernanke was right. So the U.S. avoided the double dip recession, and it continued to chug along at its plus or minus 2% growth rate. Central bankers in Japan and the Eurozone and the UK, they reversed direction And eventually they began to actually adopt some of the practices of Bernanke and the US Fed, including the use of quantitative easing, where they go out and not only control interest, the US and foreign central bankers can directly control short-term interest rates. In the US, it's through the Fed funds rate, or at least that's one of them, the Fed funds rate, where the Federal Reserve sets the rate at which banks trade excess reserves on an overnight basis. But central banks don't typically control long-term interest rates. Those are set by bond investors in the bond market. However, if a central bank wants to become a major bond investor, they can be as big as anyone. And so, first in the U.S. and then later in Japan and the eurozone, they began this process of quantitative easing, where the central bank would go out and actively buy longer-term bonds. So they'd actually become a bond buyer, a bond participant. And one of the things that happens when there's a lot of buying pressure, as you might expect, it drives up the price of bonds. And when you drive up the price, all other things being equal, the yield or interest rate goes down. So by being big bond buyers through these quantitative easing programs, first the U.S. Fed and then later the Eurozone, the European Central Bank, were able to keep longer-term interest rates down. Anyway, the U.S. was ahead of the curve on that, and the European Union and Japan and other major developed areas came along later, so they're farther back in the cycle of recovery, and that led their markets to lag the U.S. advances. And there was also a secondary factor that emerged a year and a half ago, and that, or a little more than that, when the dollar began a huge surge in value against other major currencies. Well, all other things being equal, if you earn some returns overseas in local currencies, if you earn a return in the UK stock market that's denominated in pound sterling, or if you earn returns in Germany and the rest of Europe that are denominated in euros, when you go to translate those returns back into dollars, they will be shrunk or even turn negative if they've been offset by a rise in the dollar relative to those currencies. So the combination of the U.S. being more advanced in its economic recovery and the fact that the dollar took a huge surge in value, basically were the two major factors that caused overseas returns to lag U.S. returns. This is a process that's now reversed itself. As you can see, the U.S. in the All-Country World Index, which is made up of 47 countries around, this is the developed index, 47 developed countries around the world, the U.S. ranked 35th out of 47. So one thing I want to say about the U.S. market values, this is something that if you're reading the business section of the paper, or probably any section of the paper, or watching the evening news, you're hearing people talk about the U.S. market, being at nosebleed levels, being so being at historic highs, and people are beginning to worry what that means for the future. If something's risen, every time you turn around, the Dow is passing one of the new 1,000 mark benchmarks. It briefly passed the 26,000 mark yesterday, and its advance from 20,000 to 26,000 has been extraordinarily fast. So it's not unusual to worry that when there's a rapid advance, that it may be cause for concern, that a rapid advance may be followed by a rapid decline. So there's a couple of things I want to say about that. One, to a not insignificant degree, corporate earnings are growing very quickly. And so if you look at some of these valuation levels, for example, using the price to earnings ratio, on a 12-month forward-looking basis, they're much lower because it appears that corporate earnings are continuing to grow strongly. The other point I want to make is more of a historical one, but it's also more of an economic one. Things like price to earnings ratios, which are typically used, that just shows how expensive a stock price is relative to its earnings per share. Those are not meaningless figures, but they also don't exist in a vacuum. They exist in the context of the rest of the economy, and they're impacted deeply by things like inflation rates and interest rates. Now, if you look at this chart, you can see that with long-term interest rates plotted out in red, and the price to earnings ratio plotted out in blue, you can see that they're negatively correlated. They move in the opposite direction. When interest rates rise, price to earnings ratios fall. And when interest rates fall, price to earnings ratios rise. And this is a natural relationship, and it arises from a couple of different sources. One of them is that sort of some of the fundamental models for pricing a stock is one of the most fundamental models that are used to price a stock is known as the discounted cash flows or dividend discount model, and it basically says that a stock is worth all of the future earnings you're expected to receive as an owner of that stock, discounted back to present value using some appropriate interest rate. Um, and when you discount future earnings at a low interest rate, it adds more to the present value than when you discount it at a high interest rate. And so when you have low interest rates, sort of traditional discounted cash flow models are going to say, well, this thing is worth more, discounting at this low interest rate. The other thing about low interest rates is there's sort of a supply and demand um, impact. Low interest rates mean that money market accounts and CDs and by and large bonds are going to have low yields. And so investors tend to gravitate towards stocks which appear to have more return probability. And so the combination of those two things causes prices and valuations to be higher when interest rates and inflation rates are low. And so to some degree, that's a natural thing. Back in the late 70s and early 80s, for those of you on this webinar who remember those days, we had extremely high inflation and interest rates. We had high double-digit interest rates. And during that period, the S&P 500 had single-digit price-to-earnings ratios. So if it's appropriate for the price-to-earnings ratio of the S&P 500 to be 8 when interest rates are in the double digits, it's not crazy for it to be 22 when interest rates are in the low single digits. And until recently, they were really close to zero. So anyway, that's just some context setting to say that you can't just look at averages. You just can't look at the numbers and say, well, the price earnings ratio is currently 22. The long run average is 15 or 16. It obviously is way above the long run average. That's a danger sign. No, you have to look at the larger context of what's going on in the rest of the economy. Now here, let's coming back to the global scene. And again, this is what happened in 2017, the 12 months ending just a couple of weeks ago. And you could see that emerging markets had by far the highest return of all segments, of all geographic segments, uh, chalking returns of over 37% for 2017. Next up were stock markets in the developed markets like the Eurozone and Japan and Australasia. Um, Finally, the U.S. market came in third, and global real estate came in fourth. I think it's interesting to note that global real estate, nonetheless, if you look at the returns since 2001, has actually had the second highest return after emerging markets. Now let's turn our attention for just a moment to the new tax law, which was just enacted a few weeks ago. Um, I'm going to just talk about some of the broad features, and then we'll get into what some of the implications might be. So, speaking very broadly, one of the major things it did is it eliminated or deeply curtailed many of the deductions that were typically available for those who itemized their deductions. And at the same time, it increased the standard deduction. In fact, it it essentially doubled it, a little bit more than doubled it, to 12,000 for individuals and 24,000 for married couples. Um, Interestingly, even though the standard deduction is doubled, its impact is the impact of that is not as large as it may sound because personal exemptions were eliminated. So, for example, individuals, pardon me, well, anyone could claim a personal exemption of over $4,000, which means a married couple would claim over $8,000. And if they had children, they were claiming as exemptions. If they had even one, then their deductions are actually, the standard deduction is actually smaller than what they were able to claim previously by combining the standard deduction with 3 exemptions. Um, in general, however, it is going to result in more people claiming the standard deduction. And this is largely because so many other deductions that you could previously itemize have been curtailed or eliminated. Specifically, um, all state, local, and property taxes combined, you cannot deduct more than $10,000 of. Um, you cannot, for new mortgages, deduct interest on loans exceeding $750,000. Now, current mortgages are grandfathered. So if you have $1 million mortgage and you're deducting interest on that, you're good to go. The one thing that when people hear about this grandfathering that is important to remember is that this only applies to qualified acquisition debt, which involves um, mortgage debt used to acquire a home or to improve it. So if you have an $800,000 primary mortgage that you use to buy a home, if you have a $200,000 home equity line that you use to remodel the home, then the full $1 million is still going to be deductible. It's grandfathered in. But if you have $800,000 you use to acquire the home and $100,000 that you took out on a home equity line and you used it to buy a timeshare or a new car or take a big vacation, the interest on that portion is not grandfathered in. It's not going to be deductible. Now, the good news is that those mortgages that are grandfathered in um, will continue to be grandfathered even if you refinance them. So that's good news for those with mortgages in excess of 750 who are worried about losing that interest rate deduction. In general, the other thing that the new law does, is it lowers rates and raises brackets. It keeps the same. It, it retains 7 rates, which is what we had before. Some of the early proposals were going to reduce them to as few as 4 rate brackets, but instead they retained 7 brackets that as existed before. They just lowered the rates on basically on 5 of those 7 brackets. Most individuals, based on our analysis, and I'll say more about this in a few minutes, based on our preliminary analysis, most individuals are going to pay more or less the same or less. Um, it, what, it, what it appears is going to happen is that what you lose through the reduction in deductions is going to be at least offset, if not a little bit more so, um, from the lowered rates. So that's the good news, is that you're probably not going to lose anything, and you may actually get a net deduction. Those individual rates do sunset in 2025. We're back into a world of sunsets. That was something we were going through a lot in the first part of the 21st century. All through George W. Bush's presidency, there was sort of a trapeze act where we kept moving from one law to the next that was involving both income taxes and estate taxes, and the provisions kept sunsetting, or they had sunset provisions that had to be addressed. Um, these individual rates, these lower rates, they do sunset in 2025. The drafters of this law are pretty much on record saying they felt fine putting the sunset provisions in because it allowed them to pass this law using a process known as reconciliation, which means they didn't need to have more than 51% of the votes in either chamber in order to pass it, because they had structured it so that it had certain revenue effects. The only way they could do that is by having some of these rates sunset. Whether or not they'll be made permanent in 2025, who knows? But that's 7 years from now, so enjoy it while you can. It permanently lowered corporate tax rates from 35% to 21%. And again, I'll say more about that in a few minutes. So let's talk about the impact on the markets. So as I mentioned earlier, it may very well boost economic growth through increased corporate investment, but we may also see more share buybacks. This is one of the ambiguities that we have to wait and see. We have to actually observe as the year unfolds, is what companies are going to do, what corporations or major corporations are going to do as more money starts dropping to the bottom line, because they're subject to lower rates, and as they have the opportunity to at much more attractive rates, repatriate dollars that have been stashed overseas. If they use those to actually invest, if they hire more, if they invest in more plant and equipment and so forth, that would have a stimulative effect on the economy. If they just use them for share buybacks, which is something that we've seen a lot of actually already, that's good for shareholders and that's good for the stock market. Doesn't have any impact in particular on the economy at large. Um, the other thing that I've also mentioned is that whatever impact it's going to have on the larger economy, it may be offset um, if the low unemployment rate causes wages to rise faster, if it causes inflation to rise, thus causing the Federal Reserve to accelerate its increase in interest rates. All of those things could essentially offset any of the stimulative effect of the lower that the lower rates would otherwise have. It will, as I mentioned, it will improve corporate bottom lines. But here's something that's important to remember: that's already priced in. To the degree that corporate profits are going to be improved, that got priced into the market basically the day the law passed and was signed by the president. Um, this is the kind of thing, markets don't wait for something to emerge; they react based on what could be. They're always discounting the future to the present. And so, for those of you who have been paying attention over the last 3 to 4 weeks since the law was signed and it became the law as of 2018, the markets have continued to rise, and they've actually continued to rise quite strongly. And I think you can look at that in part being the markets pricing in the impact on the corporate bottom line of the tax cut. So that's there. Don't look for that to be something you can harvest in the future. Assume that if you're in the market, you've gotten those returns, and maybe the share buybacks will create a further tailwind. That's not necessarily priced in. You know, investors don't know what companies are going to do with these extra dollars. So on the bottom, basically the bottom line is something that my physician always says to me when I ask him about homeopathic remedies. He says, "Well, it won't hurt you." And I look at the new tax law from an economic standpoint and a market standpoint on a forward-looking basis and say, well, it won't hurt you. We don't know how much good it will do, but there's no real reason to believe it's going to do any harm. Now, I'm not going to dwell on this for very long, but this is just, I wanted to briefly show you what the new brackets look like. This is for individuals, and these are the brackets for married couples. And you can see that the first two brackets are the same, both in terms of the dollar thresholds and the actual tax rate, or I should say they're very close to being the same, that 10% and 15% bracket. As you move into the next bracket, that's where you start to see a change. What was a 25% bracket becomes a 22% bracket. And then at the next threshold, what was a 28 becomes a 24% bracket. And it goes to a higher level. It goes to $315,000 of taxable income rather than 233. And then what was a 33% bracket becomes a 32. It goes to about the same level. And then what was a 35 is still a 35, but it goes to a much higher level. It goes to 600,000. And whereas previously the highest bracket was almost 40%, and that began at 470, now the highest bracket is 37%, almost 3% lower, and it starts at 600,000 and goes from there. Capital gains taxes did not change. Not only did they not change, we still have the 0%, 15%, and 20% rates, but the brackets didn't change either. Previously, the way it worked is if you were in one of the first two, if you were in the 10 or 15% income tax brackets, you were in the 0% capital gains bracket. And then if you were in the next three brackets, you were in the 15% capital gains bracket, and above that, you were in the 20%. So the capital gains brackets lined up perfectly with the income tax brackets. That's not the case. For whatever reason, Congress carried over the old brackets for capital gains. So there's a bit of a misalignment there, which for tax planning purposes will just add it's not going to add confusion. It's just going to add an extra level of complexity when calculating the impact of different tax scenarios. The 3.8% investment earned investment income tax, which was part of essentially it's a Medicare tax. It was part of Obamacare or the Affordable Care Act. That 3.8% rate is also still present and with the same thresholds as before. So capital gains rates haven't changed. The thresholds haven't changed. One of the scary changes that was being proposed at one point was that investors would have to use what's known as FIFO accounting whenever they sell something for a gain. FIFO is an acronym, means first in, first out. And what it meant was, normally when you're investing in stocks or mutual funds, if you invest repeatedly over time for any given holding, you may end up with 3 or 5 or 10 different trade lots, 3 or 4 or 5 different chunks of stock that you acquired at different times at different costs. Um, Historically, you could designate whichever one of those you were selling when you made a sale. So naturally, if you wanted to minimize taxes, you would say, well, this this particular trade lot that has the highest cost basis, where there's almost no gain relative to the current market price, that's the one I'm going to sell. So I'll raise the same amount of dollars as I would selling another trade lot, but I'll generate very little in capital gains. Well, there was a proposal that would have forced a FIFO treatment, which means first in, first out, so that you would be mandated that you would, when you were selling something, it would be assumed that you were selling the oldest trade lot. Well, all other things being equal, the one you bought 10 years ago probably has a much bigger embedded gain than the one you bought 10 days ago. And so it would force you to be selling those trade lots with the largest gain. Fortunately, that was dropped. And so now we can continue to pick and choose choose those trade lots that generate the least gain and have a little bit more control over that. So that's all I'll say about that. Well, I guess the real point I was going to make is that with the FIFO treatment not having become part of the final bill, when it comes to managing gains in a portfolio, we're sort of where we always were. This is one of those areas where there aren't going to be big new strategies. Um, if there was going to be a big strategy, it would have been raising extra capital gains last year, prepaying the state income tax for those gains, and being able to deduct it on the tax return. We looked at most all of our clients' situation and found that for many of them, where that might have been other things being equal, that might have been a good strategy, they were subject to the alternative minimum tax, which would have negated the value of it. Because when you're subject to AMT, you can't deduct state income taxes. So there was a potential strategy late last year. A handful of people could take care of it, could take advantage of it. Most can't. We're now in a world where we're back to where we were. For the foreseeable future, everyone should just manage their portfolios as they always have. There aren't any new strategies when it comes to realizing or not realizing capital gains. So now let's talk specifically about the impact of the new tax law on individuals. So, as I've mentioned, there are fewer itemized deductions and a higher standard deduction, and this means a lot more of you are going to be using the standard deduction. A lot of people who were always itemizing will now use the standard deduction of either $12,000 or $24,000. Now that does actually make certain tax planning strategies more attractive than they were previously, including one called bunching, and I will give a specific example of that in a few minutes. So that is one strategy. It's not a new strategy, but it's one that's newly attractive with this particular change in the tax law. As I mentioned, most of you, as a consequence of the loss of or restriction on many deductions, you'll actually see your taxable income go up. But because the tax rates went down to a significant degree, those will offset that rise in taxable income, and you'll see either no change or in fact possibly for many of you a small reduction in your actual tax bill. They also raised the threshold for the alternative minimum tax. So many of you who are accustomed to being in AMT every year will find that you're not any longer, which can be a good thing. So now let's talk about this idea of bunching. So here's an example where someone in 2017 who paid $9,000 in state income taxes, $7,000 in real estate property taxes, $10,000 in mortgage interest, and gave $4,000 to charity, they would have $30,000 that they could deduct on Schedule A of their tax return. And then they could also take, if it was a married couple, they could take $8,100 in personal exemptions. This year, things have changed. This year, the combined state income taxes paid and property taxes paid are limited to $10,000. So what was previously a $16,000 deduction is now capped at $10,000. And so in this particular example, it means that and also because exemptions are have gone away, it means that the total allowable deductions are $24,000, which is the new standard deduction amount. So if your allowable deductions are $24,000 or less, you're just going to choose the standard deduction. So here's an example where someone who was previously itemizing will take the standard deduction now because the deductions available to them have been curtailed, and the standard deduction is increased. But now let's see what the a bunching strategy might do for this particular person. Okay, so same scenario in these first two columns, except that we have doubled, rather than the usual $4,000 contribution to charities, this person has now doubled their contribution. They've doubled up. They've done 2 years worth of contributions at once. As a consequence of that, even though the state income and property taxes are limited to $10,000, combined with the $10,000 in home mortgage interest, that higher charitable deduction gets them to $28,000, which means that they would actually get an additional $4,000 worth of deductions and thus additional tax savings compared to just claiming the standard deduction. Now, if you use something like a donor advised fund, which I know many of you do, and we're happy to talk to anybody who doesn't have one yet, it really aids this strategy because you can put 2 years worth or 3 years worth of your normal charitable giving in the donor advised fund in 1 year. You could take the full deduction in that 1 year. In this example, you could donate $8,000 to the donor advised fund in 2018, take the full $8,000 deduction, thus increasing your net deductions and decreasing your tax bill, but you don't have to give the money away in 2018. Once the money is in the fund, you've taken the full deduction, but you can parse it out any way you want. So you could continue to give money at the rate of $4,000 a year. It's just that you would start loading your donor advised fund every other year instead of doing it smoothly. So your charitable giving would remain the same. Your charitable deducting would be bunched into every other year. So now let's talk about the notion of managing change and uncertainty, because as Yogi Berra famously said, it's tough to make predictions, especially about the future. I've talked about some predictions in the last 45 minutes that have been made by the World Bank and the International Monetary Fund, and maybe even some predictions that I've slipped into making myself. The point is that we can make guesses about the future that are informed by what we know about the present, but the future will always be fundamentally unknowable. Changes in interest rates, inflation rates, renewed volatility. We've been living in a world in the last year and a half, where volatility in the markets has dropped to historically low levels, levels that normally don't correspond to the kind of high returns we've seen. Renewed volatility could have a big impact on how you view the markets. Central banks, in reaction to other things going on in the economy, could have a big impact. If the European Central Bank decides that they're gonna scale back their quantitative easing faster than they originally intended, or they're going to raise short-term rates. If the Federal Reserve decides to raise rates faster than they originally planned because they're worried about inflation, all of these things could have an impact. And we can't leave out animal spirits. Originally, John Maynard Keynes, the famous economist who gave his name to the Keynesian school of thought, when he talked about animals, when he coined the term animal spirits, he was really talking about entrepreneurs and how unpredictable or business owners more broadly, I should say, and how unpredictable they were when it came to how much they would spend investing in their businesses. But I think we can also apply it more broadly to sort of all investors, not just business investors, but all investors in the market. There's this thing called sentiment, and sometimes sentiment can change, and you don't know where it's going to take you. Many of you have heard me say before that we build portfolios that have that don't sport lofty valuations. And we do it two ways. We do it by being global, and markets outside the U.S. are not sporting valuations as high as markets inside the U.S., and so that lowers the overall valuation level. And we also skew towards value stocks, which by definition are trading at a lower price relative to their earnings or assets than the rest of the market. And so that creates a lower valuation. But in the short run, everything moves in lockstep. In the short run. In the long run, these differences matter. But on a day-to-day, week-to-week, month-to-month basis, things move in lockstep. And so if the Dow Jones Industrial Average or the S&P 500 decided to fall out of bed and have a bad day or a bad month, it's going to drag everything else down with it. So we have to worry about these things no matter how we structure our portfolios. So what do we do? Well, the only thing you can do, absent having a working crystal ball, which I don't, and I don't believe anyone does, is you could the most effective strategy is to build resilience into your financial affairs. You want to make sure you have adequate cash needs for any emergencies or any expected expenditures. If you know that if you know that you're going to be remodeling the kitchen, set that cash aside now. Don't leave it in the market. And even beyond that, even for the things you don't know about, make sure you have an adequate cash reserve. There are lots of rules of thumb. We prefer to come up with a target emergency fund that's based on a person's very specific personal circumstances and the very specific profile, financial profile of their life or lives. But if you had to take a rule of thumb, 3 months or even as much as 6 months, but certainly minimally 3 months worth of after-tax earnings or fixed expenses, somewhere in that ballpark would be a good starting point for an emergency fund. And then again, if you have known expenditures, they're going to occur within the next 12 to 18 months. If you know you're going to spend $80,000 remodeling the kitchen, probably 9 or 12 months from now, set that money aside now as cash. Don't leave it in the market. That's short-term money. The second thing is that if you're actually spending from your portfolio on an ongoing basis, make sure that there are adequate, stable reserves to meet those spending needs for an extended time. Our particular approach and our particular policy or policies is to ensure that there's enough in a stable bond reserve, and it really is a stable reserve. The way we conceptualize and structure the bonds, they're very short term, very high quality, very broadly diversified, globally diversified, and so they're more or less immune to interest rate rises or economic shocks. So that is a stable reserve. We like to size that stable reserve for those who are retired or otherwise have a regular spending need. We like to size it to support at least 6 or 7 years worth of spending. This means that if we have a bump in the road, if we have a cyclical downturn in the markets, you would be able to meet your spending need without worry for 6 or 7 years before you'd ever have to worry about selling any of your stocks or your mutual fund shares. And that, we believe, 6 or 7 years is a sufficient time period to allow them to recover from a cyclical downturn in the market. Broad diversification and rebalancing. You don't want to be unduly exposed to the risks of a single company or a handful of companies or a single industry. You want to be broadly diversified across the world, across countries, across all the markets, across both large and small company stocks, because that means that at worst you're exposed to the risks of the system. And therefore, if you have any belief that the system is going to recover, then if that's your only risk, then you can believe that over some reasonable period of time, 6 or 7 years, then you too will recover. Your portfolio will recover. And you must have a disciplined rebalancing strategy. When things get above a well-defined threshold, you need to be prepared to sell them back to target and take that money off the table. One of the things that we did late last year with many of our portfolios, you recall from an earlier slide that the markets with the biggest return last year were emerging markets, which were up 37%. Well, as you might imagine, the emerging market allocations within our portfolios were all beginning to exceed their target range by more than 20%, which is our trigger threshold. And so late last year, even though we were not scheduled to do it until January, we just decided to pull the trigger a little early, and we sold all those back to target, took all of those gains off the table, and placed them in the stable reserve. So a rebalancing strategy keeps you from getting overexposed to expensive markets. So that even though the markets may have risen dramatically, it's not a cause for fear if you're constantly taking money off the table and selling them back to target, selling them back to target. You're still going to retain some risk in the short run, of course, but you're not going to develop an outsized risk because you've allowed some segment to run away and not rebalanced it. And finally, sit back, breathe, and focus on controlling the things you can control. That involves all the things I've just mentioned. It involves making sure you have the right types and amounts of insurance and your estate plan is up to date and you're taking advantage of any relevant tax strategies. Just focus on controlling the things you can control and don't worry about the Jabberwocky. Okay, now I have shared everything I wanted to share today. And if anyone has held any questions to the end, please, um, you know, raise your hand, type out a question. Um, so one of the questions that we had was, um, with the stock market way too high for comfort, where can we move our money to be safe and ride out any drastic drop? We don't like being fickle with the news, but this stock rise is way too fast to be secure. Well, I'll go back to what I've just been saying actually in the last couple of slides, and that is yes, the market has risen very rapidly, especially in the U.S., but even overseas. So, as I said, those markets, out out outpaced the U.S. market last year. Um, I think that the kind of stable bond reserve that I've been talking about is absolutely the place that you want to be harvesting those returns, those excess returns, harvest them and move them to that safe reserve. The thing that we would say is don't don't be binary. Don't do all or nothing. It's important for us to be measured. So just as we did with the emerging market allocations, if something has a huge run, we're going to take some money off the table. We're going to take some money off the table and we're going to move it to that stable bond reserve. We're just not going to take it all off the table. You always want to retain some upside potential. I'll just tell a brief story about a historical period that I lived through, and many of you probably lived through as well, and that was the late 90s and the dot-com boom. Well, in the late 90s, in the mid 90s, in 1990, well, even before in the first half, 1994, the Federal Reserve, this is this is a mechanism I've talked about several times. The Federal Reserve thought the economy was overheating and they were worried about inflation, and so they raised interest rates 7 times over the course of a year. And the impact of raising interest rates 7 times was, first of all, it crushed the bond market, and the stock market took a big fall. But it did tamp down the incipient inflation. And then the Fed did what they do in circumstances like that. They took their foot off the brake, and the markets took off. And the S&P 500 rose 37.5% in 1995. And by the end of that year, a lot of people said, "Holy crap! Almost a 40% rise in one year. That's way too fast. This party's over. I got to get out and go to the sideline." The problem is that the next year it rose by 22%, and then the year after that it rose by 19%, and then the year after that it rose by 26%, and then it rose by 20%. And then yes, in the year 2000, when the dot-com crash hit, the markets were down in 2000, they were down in 2001, and down in 2002. But if you run the numbers, what you'll find is that if you had gotten to the sidelines at the beginning of 1996, you would have missed the dot-com meltdown in 2000, 2001, and 2002. But you also would have missed all those subsequent gains in 96, 97, 98, 99. And missing those gains made you worse off than avoiding the losses made you better off. You actually would have been ahead of the game if you just ridden out the subsequent rise and ridden out the subsequent loss. So, I have a joking phrase that's only half joke. It's kind of my motto around the market. The market doesn't give a damn what you think, and the market doesn't give a damn what I think. Um, you know, we can have lots of opinions that are objectively sound, but the market's going to do its thing. And it's just been shown again and again that trying to outsmart the market almost invariably sends us in the wrong direction. Um, let's see. Okay, I think I've talked about that. Um, so equity lines. So there was a question about reiterating what's happening with equity lines. So the thing about an equity line is that you, a home equity line is potentially treated exactly the same as a regular mortgage. The only way in which it would be treated differently is if it was not used to acquire or improve your property. So that's where the difference comes in. If you pulled money out using an equity line and you spend it on a car or a vacation or all of the above or living expenses, um, that's the interest on that is not grandfathered in. But if you pulled money out on an equity line and you used it to remodel your kitchen, or make any other improvements on your home, that is grandfathered in, including if you refinance the first mortgage and the equity line into a new first mortgage, that would all be grandfathered in. Another question. Every time the stock market goes up, a lot of my portfolio increases in value and I reach a new emotional threshold. I invariably reset my this is the minimum value for me to feel comfortable. Why do I keep resetting that value? That's such a brilliant question and such a insightful and self-aware question. There's a huge body of research that's developed over the last 30 years called behavioral economics and behavioral finance, and it's research into how the normal human being, I should say, the normal human brain thinks, how we all think. You know, there's 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 a Meyer Statman, who's an economist in this field at Santa Clara University, likes to say, there's rational thinking, and then there's normal thinking. It's not irrational; it's just normal. And so there's this uh, there's this phenomenon called anchoring, and anchoring is this propensity for us to get anchored to a price. And then all of our subsequent assessments of what's happening are based on that price. Now, retailers, they try and use that against us by this is why they will say um, this is why they'll say this is normally priced at $1,000, but we're putting it on sale for $699. Well, they've anchored you to 1,000, so $699 sounds like the cheapest thing you've ever seen, or relatively speaking. So they're very consciously trying to anchor you to a high number, so because that deeply influences the way you assess the number they're subsequently showing you. We do the same thing. We do the same thing with uh, we do the same thing with the stock market or the value of our portfolio, as we get anchored. I've seen people do it with individual stocks, for that matter. Get anchored to a particular price of Apple, and then when it drops, not want to sell it until it rises back up again. I've back in the days when I used to gamble, I used to love playing blackjack until I took too many classes in statistics and probability theory, and it kind of spoiled it for me. But I can remember back in those days, I would be playing blackjack. I'd be playing by my very, very grounded policies. It's a very policy-based game, I think, if you play it right. And all of a sudden, I'd be up $100, or I'd be up $200, and I would get anchored to that amount. And then I'd suddenly be down, and it's like, well, if I can just get back to 100, then I'll cash out. Well, of course, I never got back to 100, but I was getting anchored. So it's just, I guess the thing is, I won't beat this topic to death any more than that, but it's just the way we're all wired. It's the way we're all wired, and so that's one of the reasons why I would like to get you anchored on something else. I'd like to get you anchored on the fact that you've got 7 years worth of spending in a stable reserve, and so the minute the price of the portfolio starts to fall, think, whoa, wait a minute. let me look at my stable reserve. It's still there. It's going to meet my needs for the next 7 years. In a sense, I could just not even care what's going on in the rest of the portfolio unless I believe that it's never going to recover. But if you believe it's eventually going to recover, then you don't have to worry about it for 7 years. Another question: can you confirm that mortgages on second homes are grandfathered in? Um, yes. The up to the threshold, up to the $1 million threshold that previously existed, you're grandfathered in. Question: how will the new tax law affect California specifically? Um, one second. How will the new tax law affect California specifically from a state government and state perspective? Um, well, it's going to it's it's a good question. Um, it's going to make it harder for them to raise taxes, and I don't think that. I mean, I'm not sure how many plans the state had to raise taxes as it is, but it certainly is going to make it harder to raise taxes when they're not going to be deductible. There'll be more resistance from the electorate, and the other thing is that some of the some people have worried that there might be an exodus of individuals or businesses that will have some dampening effect that will lower the tax base and thus lower revenue to the state. Um, that's just a huge question mark. I mean, one can speculate, but we're going to have to wait and see because it comes back to that whole ceteris paribus thing. Uh, that all other things being equal, maybe an effective rise in my state income taxes because I can no longer deduct them might cause me to want to move out of state. It might at least slightly raise the someone who's right on the borderline between moving to Nevada and not. That might push them over the line. But that's all other things being equal. It may be that that California continues to have the booming economy it's been showing, and that the economic benefits of continuing to live here outweigh the impact of the effective rise in taxes that the new tax law creates for state income taxes. And the second part was thoughts on home values in the California and Bay Area. Man, that's one where I'm going to say my guess is as good as anyone's. Obviously, the home values here are higher than home values in the San Francisco Bay Area. I think are the highest other than Manhattan, or maybe even have passed Manhattan on a per square foot basis. Um, and a lot of that is clearly driven by demand. We have so much of the leading edge tech sector has moved from Silicon Valley into San Francisco. Um, and the and that's caused a huge demand for housing. It's also caused a huge wealth effect where people are in general wealthier and they can afford to pay more and they're willing to pay more and they're competing for a finite stock of housing. And even with those who work in Silicon Valley, many of you have heard of the Google buses because a lot of a lot of people in tech, especially a lot of young people in tech, they want to live in San Francisco, even if they have to commute down to Santa Clara, which is why the companies have created all these, again, what are generically known as Google buses to take them down there. I think that absent an absolute collapse in the tech sector, especially the tech sector as represented in San Francisco, I think the supply and demand pressure will probably continue to be more upward than downward in San Francisco and the immediate Bay Area. Okay, let's see. We've got a question about um, the majority of the recent tax cut legislation will benefit wealthy people either directly through lower federal income taxes or indirectly through stock buybacks and increased dividends. Data has shown that while lower income groups spend most or all of additional income, higher income groups are much more likely to save or invest income. That's that they have a much lower marginal propensity to consume. That's correct. On this basis, should we expect the tax cuts to significantly boost market performance this year? Um, that's I'm going to harken back to some of the things I said earlier, and that is that you know it's it will have some effect, I think, through stock buybacks, and it may have some effect if we get a boost in economic growth. I think that the boost to corporate bottom lines has already been priced in. Um, will wealthy people who get potentially get big tax savings, will they put that money in the market? It's potentially, that's potentially the case. Um, so all of the all of the different elements of a tax cut, whether it's hitting lower income people or higher income people or corporate profits, all of those things, ceteris paribus, would tend to argue in favor of more economic growth and and a further rise in the market. These are things that are all stimulative. But again, it's ceteris paribus. We have to stand by and wait and see if faster growth causes faster inflation, causes intervention by the Federal Reserve, causes the faster growth to slow down. You have there's a rhythm to these cycles, and those are going to be the numbers to watch. Interest and inflation rates and the interpretation by the Federal Reserve and other central banks around the world are going to be key indicators for us to be watching on a month to month, quarter to quarter basis. So let's see. We have gone a few minutes over the hour. So unless we're happy to take any other questions, but unless there are any others, you should know that um, you are absolutely welcome at any time to contact me or anyone else at the company. If you go to our website, www.yabu.com, under Contact Us, you will find everyone's email address. You can feel free to reach out to us. If you're not a client, feel free to reach out to us, and we're happy to answer your questions and talk to you about any situation you're dealing with. If you are a client, you know how to reach us. So let me just say thank you very much for joining us. I really appreciate your spending this little more than an hour together, and I look forward to talking to you soon.